All information contained in this podcast is general in nature and does not consider your individual circumstances. You should consider the appropriateness of this information with regards to your individual objectives, financial situation, and needs. Welcome to Sharing More Than the Sheets, a podcast to help you and your partner make better financial and lifestyle decisions so that you can both focus on the things that you love. I'm your host, Michael Khouri, financial planner, green thumb, husband, and just dad. Now, I know this week was supposed to be a Michael's magic moment, but I thought there's a bit going on, and while I like to keep all my episodes evergreen, which means I don't like to talk about something that's currently happening so that someone can listen to this episode in 5 or even 10 years, I thought it would be really timely to talk about this topic, and that is to zoom out. Now, this is a term which you'll hear a couple of times, and I'm not just talking about zooming out on the computer or on your phone, but I'm talking about the importance of looking long-term when it comes to investing. Now, markets go up and down, and when they go up, some people talk about it. When they go down, a lot of people talk about it. Friends love to talk about it. Colleagues like to talk about it. The media likes to talk about it. And it's really interesting when markets do really well. You don't see a really big headline. Well, you do sometimes, but it's not as prominent. You don't see big headlines saying today, trillions of dollars or this many $1 million have been added to the stock exchange. But when there's a market downturn, you see these big numbers. You see, I was laughing last week. I saw an article and it showed security guards running through a building holding a folder in their arms. I promise you, when markets go down, security guards do not run through corporate buildings with folders in their arms. I'm not saying don't listen to the media, but I'm saying there's going to be a lot of distractions, and there's going to be a lot of friends, a lot of family, colleagues, people at work that are going to tell you, hey, look, I think this is what's going on, and you need to panic. Now, in these times, there's a lot of value in having a financial advisor and having someone there to help you, because we make decisions based off emotion. And if you have someone there that can help you, A, regulate that emotion, but B, look at things from a different perspective, it is going to literally change your life financially. The first thing to really think about is when you're investing money is to ride out storms in the fact that acknowledge that you are investing long-term. If you are investing long-term. Now, if you're investing money that you need within the next 3, 4, 5 years, this may not apply to you. But if you're investing funds that you don't need for 10 years, 15, 20 years plus, then think long-term. Zoom out. And this is where the term zoom out comes from. Look at a graph that shows you markets are going down. For example, if they are going down at that point, zoom out to see what they've done in the last month. Zoom out to see the last 3 months, the last 6 months, the last 2 years, 3 years, and you'll be very, very surprised. There's actually a statistic that I heard years ago, and I don't know the specifics of it, but it's something around the lines of and it's a fact or based off some research, investors that check their investments less often are more likely to actually make more money than those that check them all the time. And that's essentially just because of the fact that if you check your investments, for example, once a quarter, for example, or once every 6 or 12 months compared to every day, you're less likely to get spooked by these market fluctuations that I'm referring to. And if you can think long-term, it will avoid you from making potentially a lot of emotional mistakes. I saw a graph today, and I can share some of these with you. If you message me privately, I'm happy to have a discussion and share these with you. There are some graphs. There's a graph I saw today showing that if somebody had missed, 40 days, and in the last 11 years or so, the best 40 days, what impact that would have on their portfolio. So if there was a period where they felt, hey, look, I'm going to try to time the market. I'm going to try to sell at a particular time, buy at a particular time, and try to get on top, to try to beat the market. This is the effect it would have had on their portfolio if they had missed the best 40 days, for example, in the last 11 years. And it's fascinating. And so many times I'll speak to a client or someone that will say, hey, look, I'm going to try to, sell my shares or sell down my portfolio into cash and then buy in again at the right time. There's a lot of risk there because you might get it on the way down. You might sell at the perfect time, but there's a chance you might miss the boat on the way up. And it happens all the time. No one has a crystal ball. Even the experts get it wrong. In fact, experts get it wrong the majority of the time statistically. So my point is that no one has a crystal ball, and you can try to time the market, but it can be very detrimental to your portfolio in both the short and long term. A way to manage all this is to diversify your portfolio. So don't just have everything in a single asset class, for example. You can if you want, but without diversification, you're exposed to a lot more risk. The third thing I should say is go back to the strategy. Think about the strategy. Follow that. Don't follow your emotions. Think about why are you doing what you're doing? What is the time frame? What is the strategy? Do you have diversification in place? And just really understand that. You should understand this from day one, but if you've got a strategy, you should stick to it. Yes, the strategy should be reviewed regularly, and we do that for our clients every year at least. But it's important to have a strategy and stick to it. Stick to the plan. Part of that is consistency and just being smart around the way that you're investing. Cost efficiency is a big one. Selling down investments costs money, and there could be risks of time out of the market. There's transaction costs. There are costs of switching investments, and there's the consistency. The idea of thinking, okay, if I'm going to be doing X, Y, and Z, this does go back to strategy, but doing something consistently, not just chucking money into an investment account, a couple of times a year, but doing maybe that same amount of money, but doing it consistently over the year. Doing that dollar cost averaging, avoiding that sequencing risk, doing things so that you can have a plan, be consistent, and be efficient in the way that you're investing. And lastly, I think the point I just want to add is just to put a bit of common sense into the situation. If markets go up, if markets go down, just ask yourself, why has that happened? And most of the time, you'll actually find that it's very emotionally driven, that people are just scared of something, or they're anticipating something, or the market's pricing a change in. And you just need to ask yourself whether this thing eventuates or not. What are markets probably going to do from there? So I'm not asking you to pretend to be an expert, but I'm asking you just to use a bit of logic when it comes to market fluctuations, just to sort of think, just to put it in everyday terms, just to be very simple about the situation. Why have markets gone up? Why have markets gone down? And what could potentially be the outcomes? And lastly, I know I said lastly earlier, but lastly, communicate with people. Talk to your financial planner. Drop me a message. Surround yourself with the right people that can educate you properly so that you can make smarter and better decisions and do better with your money so that you can focus on the things that you love. Thanks for joining us on Sharing More Than the Sheets. Please make sure you subscribe to be updated with future episode releases, and feel free to share this episode with any friends or family that you think it might benefit. Please visit us at sharingmorethanthesheets.com.au to submit questions or requests for future podcast topics. These podcasts have been brought to you by Better Financial Planning Australia. To book a 15-minute phone chat, visit betterfinancialplanning.com.au.